Right now, as you are watching this, the S&P 500 is sitting roughly 8 to 9% below its all-time high of 6,978 that it hit back in January. The Nasdaq confirmed a correction in late March. The Dow did the same a day later. Oil spiked past $120 a barrel when the Strait of Hormuz got shut down. Consumer sentiment just cratered to 53.3, the lowest since late 2024. And the Atai Sentiment Survey is showing bullish investors at just 33%, well below the historical average. Everyone is scared. And I'm telling you, that is exactly when generational wealth gets built. Not when everything is green, not when your coworker is bragging about his Tesla calls, not when CNBC is running headlines about new all-time highs. It is when people are panicking, when headlines are screaming doom, when the average investor is sitting on their hands, paralyzed, waiting for some magical, all-clear signal that, spoiler, never comes until the move has already happened. Here is what we're going to break down today. The exact setup that is forming right now across geopolitics, monetary policy, tariff restructuring, and corporate earnings. And why, if you understand what is actually happening beneath the noise, this might be one of the best entry points for building serious long-term wealth that we've seen in a decade. This is not hype. This is not clickbait hopium. This is data. Let's get into it. So let's set the stage, because context matters. 2025 was a phenomenal year for markets. The S&P 500 returned roughly 18%. It hit 45 record closes. The bull market was roaring. AI hype was at full throttle. And then, as tends to happen when everyone gets comfortable, reality showed up. February 2026, the United States launched strikes against Iranian nuclear infrastructure. Iran retaliated by shutting down the Strait of Hormuz on the 4th of March. Now, for those who don't know, about 20% of the world's oil supply passes through that strait. When it closed, Brent crude didn't just rise. It surged past $120 a barrel, almost overnight. At one point, it was trading near $145 for some benchmarks. The downstream effects were immediate. Gas prices spiked. Shipping costs exploded. Inflation expectations ratcheted up. The University of Michigan S1 year inflation expectations jumped to 3.8% in March, up from 3.4% the month before. Consumer sentiment plunged, and markets, predictably, started selling off. The Nasdaq officially entered correction territory on the 26th of March. The Dow followed on the 27th of March, down over 10% from its 10th of February record close. More than half of the S&P 500's industry sectors were in correction territory by late March. The VIX Wall Street's fear gauge spiked to 35.3 in early March, the highest since April 2025. Goldman Sachs raised their 12-month recession probability to 30%. Harvard Business Review ran a piece titled, "Will the Iran War Deliver a Long-Predicted Recession?" CNN Business was asking the same question. Business Insider was saying you couldn't ignore the risk anymore. The Guardian warned that prolonged conflict could push oil above $170 and trigger a global recession. And here is where most people check out. They see that wall of bad news and they freeze. Or worse, they sell. But let's pause for a second, because this is where it gets interesting. On the 7th of April, right before Trump's stated deadline for striking more Iranian infrastructure, Iran agreed to a 2-week ceasefire. Tehran said it would reopen the Strait of Hormuz and begin negotiations in Islamabad. The market response was explosive. Stocks surged. Oil prices collapsed. Brent dropped from around $110 to roughly $93, sufty $96, within 48 hours. That is a 16% drop in oil in a single move, the largest since 2020. The S&P 500 ripped higher, closing at 6,611 on the 6th of April and continuing to rally through the week, pushing back above 6,780 by the 9th of April. Now, is the ceasefire going to hold? Honestly, nobody knows. By the 8th of April, Fortune was already reporting cracks in the truce. The Strait of Hormuz was still mostly blocked, with only 4 tanker transits recorded that day. The BBC reported oil prices climbing again as the ceasefire showed strain. Bloomberg's headline on the 10th of April read, "Are markets mispricing Iran war risks amid ceasefire? This is messy. This is uncertain." And that is the entire point. Because here is what the historical data actually tells us. LPL Financial compiled data on every major geopolitical event since World War II. In 19 out of 20 major post-WWE conflicts, they studied the market recovered to pre-event levels within about a month. The Gulf War in 1990, sharp decline, recovery within months. The Iraq invasion in 2003, markets dropped on fear, then rallied before the year was out. Even the initial COVID crash in 2020, the fastest 30% decline in history, was followed by one of the fastest recoveries. Markets do not wait for clarity. They move before the picture gets clear. And if you're waiting for everything to feel safe before you act, you've already missed the move. Now let's talk about something that might be even more consequential than the war, and that most people have already forgotten about. On the 20th of February, 2026, the United States Supreme Court issued one of the most significant trade rulings in modern history. In Learning Resources, Inc. v. Trump, the court ruled decisively that the International Emergency Economic Powers Act, or EEPA, does not authorize the president to impose tariffs. Let me say that again. The Supreme Court struck down the legal basis for the vast majority of Trump's tariff regime. The reciprocal tariffs, the fentanyl-related tariffs on China, Canada, Mexico, the tariffs on Brazilian and Russian goods, all of the IEEPA-based tariffs gone. As of the 24th of February, 2026, they were terminated. The Tax Foundation had estimated that these tariffs were adding roughly $1,000 to $1,300 to average household costs annually. That pressure is now lifting. Now, it is not all sunshine. The administration pivoted. On the 2nd of April, the White House announced strengthened Section 232 tariffs on steel, aluminum, and now copper, raising rates to 50%. And Section 301 tariffs on Chinese goods remain intact, because those operate under a different legal framework. CNBC reported in early April that some industries are still grappling with lingering trade war effects. But here is what matters for investors. The structural tariff overhang that was weighing on the economy for the past year has been dramatically reduced. The effective tariff rate on U.S. imports has come down substantially. Supply chains are adjusting, and for companies that were getting crushed by margin compression from tariff costs, particularly in manufacturing, retail, and consumer goods, this is a material positive. This isn't priced in yet, not fully, because everyone's attention is on Iran and oil, and that creates an asymmetry where the risk people are focused on is already partially resolved, but the positive catalysts are being ignored. Now, let's layer in monetary policy, because this is where the setup gets really compelling. The Fed held rates steady at 3.5 to 3.75% at both the January and March 2026 meetings. That is after a series of cuts that brought rates down from 5.5 at the peak. So we've already had significant easing. But the Fed's own dot plot still projects one more cut this year. And looking at the CME FedWatch tool, the market is pricing in the possibility that rates could stay here for a while, potentially all the way through September 2027, if inflation stays sticky from oil. Here is the thing though, the Fed is in a much more flexible position than it was 18 months ago. If the economy weakens, if those Goldman recession odds climb further, the Fed has room to cut. That is a significant backstop that didn't exist during the 2022 sell-off, when rates were still going up. And meanwhile, if you're a fixed income investor, yields are still attractive. The 3-month treasury is sitting around 3.74%. Money market funds are paying real returns. So even your cash position is earning while you wait. This is a fundamentally different environment than the zero interest rate world we lived in from 2009 to 2022. You're getting paid to be patient, and you have a central bank with ammunition to deploy if things deteriorate further. Now, here's what separates the people who build wealth from the people who just watch it happen. Let's look at what the smart money is actually doing. Warren Buffett, before stepping down as CEO at the end of 2025, spent his final years systematically selling equities and building Berkshire Hathaway's cash position to a record $373 billion. He compared the market to 1999. He said cash is like oxygen. But here is the part people miss. He wasn't hoarding cash to sit on it forever. He was building a war chest. And now Greg Abel, his successor, is starting to deploy it. In early 2026, Abel took his entire $15.3 million salary and invested it in Berkshire stock. That is not a guy who thinks the world is ending. In early April, Abel deployed $1.8 billion into Japanese trading houses. Continuing Berkshire's thesis on international value, Berkshire isn't running from risk. They running toward it, selectively, strategically, with $373 billion in dry powder. And they're not alone. Look at the broader market rotation that has been underway. Morningstar reported in February that investors are moving beyond AI into real economy stocks. Industrials, consumer defensive, energy. StoneX noted that large cap value has outperformed large cap growth by more than 11% year to date in 2026. International stocks are beating us markets by the widest margin since 1995. Bank of America's fund manager survey showed 43% of managers expect value to be the winning theme over the next 12 months. This is a rotation. Money isn't leaving the market, it is moving within it. And if you understand where it is going, you can position ahead of the flow instead of chasing it. Defense stocks have been on an absolute tear. Lockheed Martin is up 38 to 40% year to date. Northrop Grumman is up over 23%. The entire defense ETF sector hit record highs in early March. These aren't speculative plays. These are companies with $193 billion backlogs and free cash flow projections that the sector hasn't seen in decades. Vertical Research Partners estimated the top 15 defense contractors will generate $52 billion in free cash flow in 2026. Energy, particularly upstream producers, is another area where real money is flowing. BP alone has projected 22.6% earnings growth and 28% revenue growth with new projects coming online. When oil is volatile but structurally elevated, the companies that produce it print money. And then there is the AI trade. Yes, mega-cap tech has pulled back. The Nasdaq corrected. But Nvidia is still up year to date. The big tech companies have committed over $405 billion in AI capital expenditure. That spending isn't stopping. The infrastructure build-out is a multi-year cycle, not a single quarter event. If you are getting quality AI names at a 10 to 15% discount from January highs, that is not a problem. That is a gift. Look, I'm not going to sit here and pretend I know exactly what is going to happen next. Nobody does. The ceasefire could collapse tomorrow. Oil could spike again. The recession probability could rise. Any of those things could happen. But here is what I do know, and what the data overwhelmingly supports. Every single major market crisis in modern history, every one was followed by a recovery that made new highs. Every single one. After the dot-com crash, the S&P 500 fell 49%. Investors who bought in 2002 and 2003 saw massive returns over the next 5 years. After the 2008 financial crisis, when the world genuinely felt like it was ending, the S&P dropped 57% from peak to trough. But from that March 2009 low, it went on to deliver one of the greatest bull runs in history. Warren Buffett made $10 billion deploying capital during that crisis. Michael Burry, after his famous short, rotated into long positions at the bottom. Regular investors who just kept dollar cost averaging through their 401 KS came out enormously ahead. The S&P 500 has averaged a positive return in 68% of April's historically, with an average gain of 1.6%. After corrections of 10% or more, the average 12-month forward return is north of 20%. These aren't guarantees, but they are probabilities that have been tested across nearly a century of data. The people who built serious wealth during the 2008 crisis, during the COVID crash, during every major pullback. They didn't have some secret information. They didn't time the exact bottom. They simply had the discipline to keep investing when everyone else was too afraid to act. Dollar cost averaging, just consistently putting money to work at regular intervals, regardless of what the market is doing, has been shown in study after study to be superior to sitting in cash, waiting for the perfect entry point. Vanguard's research showed that while lump sum investing slightly outperforms DCA in rising markets, DCA is dramatically better than holding cash indefinitely, which is what most scared investors end up doing. The cost of inaction is the one thing nobody calculates, and it is usually the most expensive mistake of all. So let's bring this home with something actionable. I am not going to tell you to throw your entire savings into the market tomorrow. That would be irresponsible, and I'm not here to do that. What I am going to tell you is this. First, if you are not investing consistently right now, you need to start. Not because the market is going up tomorrow, but because the single biggest determinant of long-term wealth creation is time in the market, not timing the market. Set up automatic contributions. Your 401k, your ERIA, your brokerage account, whatever it is, make it systematic and take emotion out of it. Second, pay attention to the rotation. The market isn't broken, it is shifting. Value is outperforming growth. International is outperforming domestic. Defense and energy are leading, while consumer discretionary and speculative tech lag. You don't have to pick individual stocks to benefit from this. Broad-based ETFs that tilt toward value, international exposure, or specific sectors can capture these trends at low cost. Third, respect the macro. The Supreme Court just removed the biggest tariff overhang of the last 2 years. The Fed has room to cut if needed. Corporate earnings are still growing. And while the Iran situation is genuinely uncertain, the historical playbook on geopolitical shocks is overwhelmingly clear. Markets recover, and they usually recover faster than anyone expects. Fourth, and this is the one most people won't do, build a watch list now of the things you want to own. If prices dropped another 10 or 15%, have a plan before the volatility comes, because when things get chaotic, the people who've already done the thinking are the ones who act. Everyone else just refreshes their portfolio app and panics. There is this quote that gets attributed to Rothschild: "Buy when there is blood in the streets." It is overused. It is a click at this point. But there is a reason it is a click. Because it keeps being true. Right now, there is blood in the streets. There is a war. There is an oil shock. There is political uncertainty. There is fear in sentiment surveys, in consumer confidence numbers, in the VIX, in the headlines, in the comments section of every financial video on this platform. And somewhere in that mess, for the people paying attention, for the people who understand that volatility is the price of long-term returns, there is an opportunity that only shows up once every handful of years. The question isn't whether this opportunity is real. The data says it is. The question is whether you are going to be someone who looks back in 3 to 5 years and says, "I am glad I acted," or someone who says, "I wish I had." That is up to you. If this breakdown was useful, hit subscribe. I'll keep these coming. See you in the next one.